Welcome everyone to the second panel. We've had an exciting first panel which took the stock of where we were. That was continued by the speech which gave us an assessment of what the UN and other institutions are doing. Obviously, it's exciting to see what the institutions that are kind of leading here are doing. And of course, it indicates what other players could be doing and how much further we could move. And in a way, that's the topic that we will tackle here in the second panel. We have an exciting group of panelists. What I'll do is I just briefly introduce each one of them as we start. Each panelist will briefly introduce his, her institution and provide a substantive comments. We'll go through from my right to the left, your left to the right here, and then we'll have time for questions and answers. So we'll start with Ian Perry, who is the Principal Environmental Fiscal Policy Expert in the Fiscal Affairs Department of the IMF. Prior to joining IMF in 2010, he was at Resources for the Future for 15 years. He was he holds PhD of Economics from the University of Chicago, and his research focuses on analytical models to quantify the different impacts and efficient levels of a wide range of environmental, energy, and transportation policies. So, Ian, if you could both introduce your unit, the institution, and then give us your first set of comments.
Thanks very much, Jan. Well, I mean, our main message at the IMF is that we think that ministers of finance have a critical role to play in climate policy. First of all, in championing carbon taxes or carbon pricing instruments, and we think these are the most effective policies for promoting the entire range of mitigation opportunities across the economy and also mobilizing investments in low carbon technologies. These instruments, it's also critical that the revenues from carbon taxes are put to good use. So most obviously to lower the burden of other taxes in the fiscal system. And then thirdly, we think that finance ministers have a critical role to play, potentially in administering carbon charges for fossil fuels. So we see carbon taxes or similar instruments as a straightforward and very practical extension of what finance ministries in most countries in the world are already doing, that is administering motor fuel excises. So building carbon charges into those motor fuel excises and extending similar charges to the supply of other petroleum products, coal and natural gas. To us, that's a very simple and practical extension of what governments are already doing. We try to play our part in moving this agenda forward in three main ways. Firstly, we have our outreach activities. We have an active conference agenda where we work with other international organizations to bring together policymakers to discuss the case for and the appropriate design of carbon pricing and energy pricing reform more generally. We stand ready to provide assistance, technical assistance to our member countries, and we are providing technical assistance on energy subsidy removal, green fiscal reforms, and carbon pricing issues. But this technical assistance, it's demand-driven. I mean, countries have to express an interest in these issues before they're part of an IMF mission or an IMF report. And then in addition, we have our analytical agenda. In the last few years, we've produced a handbook which provides practical guidelines for policymakers on the design of fiscal policies to mitigate carbon emissions. We have another book just out this month, actually, which discusses implementation issues should at some point the United States move ahead with a carbon tax as part of a broader fiscal reform. We have another book which quantifies the magnitude of fossil fuel energy subsidies in different countries, and yet another book which quantifies for over 150 countries what we think are ballpark estimates of the appropriate taxes on fossil fuel products that are needed to reflect not only the carbon emissions but also the air pollution emissions and traffic congestion from transportation vehicles and so on. So the point of that book is to provide actionable guidance to developed and developing countries alike on how they can put into practice the principle of Pigouvian pricing, pricing for the adverse environmental damages of energy use. We're also asked in this panel to think about challenges in decarbonization. I mean, for us, we think that to establish an effective and sustainable policy, it's really critical to get the design details of carbon pricing right. I mean, to us, this is all common sense, but obviously you want to comprehensively cover the emissions. You want to establish stable and robust emissions prices. We would suggest upwards of $30 per ton. And you also want to exploit the fiscal opportunities from carbon pricing. You can recycle these revenues in broader tax reductions or to meet fiscal consolidation needs. So it's, we would caution against earmarking these revenues for other purposes like low-value spending, or we would caution against giving away the allowances for free in a emissions trading system, because that's depriving governments of valuable revenue sources, which are especially critical these days given the rapid run-up in debt to GDP ratios since the 2008 fiscal crisis. In terms of carbon taxes versus emissions trading systems, I mean, in principle, either system can achieve these desirable design characteristics, but we think that trading systems are just a little bit more convoluted, and hence perhaps there's a little bit more of a risk of design problems. In a trading system, to establish price stability, you need to combine the trading system with additional measures to promote price stability, tight price floors and price collars. But then if you have a tight price floor and price ceiling, but then if you have a tight price collar, that obviates the need for much emissions trading. In addition, if carbon pricing is to be part of a broader fiscal reform, which is what we would recommend, then the environmental agency that's administering the trading system has to auction all the allowances and then remit all of the revenues to the finance ministry. And in fact, in the EU emissions trading system, we can see that there's significant scope for reform, given that that system's only covering about half of the emissions. And then emissions prices have been volatile, and in recent years they've been rather low, way below levels that are needed to reflect the environmental damages. And then in addition, in the early stages of the trading system, the fiscal opportunities were forgone by giving away free allowances. So to help move carbon pricing forward at the domestic level, we obviously think that it's important to address burdens on low-income households. Here we would emphasize that holding down energy prices below levels warranted on the grounds of supply costs and environmental damages is a very ineffective, inefficient way to help low-income households, given that most of the benefits are going to leak away to higher-income households. Much better targeted measures for these groups. Similarly, for addressing burdens on vulnerable firms, I mean, again, over the medium to longer term, you want responsible energy pricing to promote an efficient allocation of productive resources across energy-intensive and other sectors of the economy. But clearly, in the short to medium term, you might want some transitory measures for worker assistance programs and so on. At the international level, we think that the obstacles which have held up progress at an international level, the free rider argument that why should one country go ahead with emissions mitigation if it bears the costs, but the climate benefits are borne by all countries, and the argument that compensation is needed for developing countries to compensate for the emissions mitigation costs, we think both those arguments might have been somewhat overblown, at least when you take into account the domestic co-benefits from carbon pricing. Our work suggests that carbon pricing is actually in most countries' own national interests because of the domestic co-benefits. Most obviously the reduction reduction in air pollution deaths as carbon pricing leads to a reduction in combustion of coal and other fossil fuels, but in addition reductions in traffic congestion, accidents and so on as carbon charges lead to reductions in vehicle use. And actually our own work suggests that averaged across the top 20 CO2 emitting countries, they should be pricing CO2 emissions in the order of quite a striking $57 per tonne of CO2 simply to reflect these domestic co-benefits, environmental co-benefits, before even counting the global carbon benefits. Now, clearly, you could argue that other policies are needed to address these, are more efficient to address these co-benefits, but we think it's entirely appropriate to take into account these co-benefits when you're evaluating carbon pricing policies, given that there's a lot of inertia. It's going to take a long time before other policies, such as air pollution taxes, are comprehensively implemented. At an international level, we also think to complement the UN process, another promising approach is a carbon tax floor amongst the top 15 or so emitting countries who account for about 3/4 of the emissions. So under this approach, the tax floor provides some degree of protection for all countries against the risk of tax competition, yet individual countries have the flexibility to price carbon at higher rates if they wish to do so for domestic fiscal reasons or domestic environmental co-benefits, or maybe just because carbon pricing is politically easier in a particular country than it is in other countries. And there are precedents for these types of carbon tax agreements in the European Union. There are tax agreements, minimum tax agreements for value-added taxes and excises on alcohol, tobacco, and a range of energy products. Just very quickly on climate finance, advanced countries have made this pledge to mobilize $100 billion a year from 2020 onwards from public and private sources to fund climate projects in developing countries. We think that the public revenues don't have to come from innovative sources, but we think that charges on international aviation and maritime fuels are a very promising and practical source of funding, given that the claim of national governments on the tax base is not as solid as it is for domestically combusted fuels, and that these fuels they're not subject to excises as domestic transportation fuels are, and they receive subsidies from the broader fiscal system. For example, passenger travel for aviation is not subject to value-added taxes. And then the centerpiece of efforts to leverage the private sources of funding has to be carbon pricing, in our view. So finally, we think this is an opportune time for moving ahead with carbon pricing reforms, given the dramatic fall in energy prices, given the remaining pressure on fiscal budgets since the fiscal crisis of 2008, and given the need for countries to make carbon mitigation pledges in the run-up to Paris.
Thank you very much, Ian. I think that's an excellent start conceptually in terms of the carbon pricing, the assessment of alternatives, the potential gains, the obstacles. So I think it's perfect way to bring in our second speaker, who is David Sanderlow. David is the inaugural fellow at Columbia's University Center on Global Energy Policy. Prior to joining us here, he was various senior positions at the U.S. Department of Energy, including Undersecretary of Energy, Acting Undersecretary for a while, Assistant Secretary for Policy and International Affairs. He was before that a senior fellow at Brookings Institution. He was part of the Clinton Global Initiative, and even before that he served as Assistant Secretary of State for Oceans, Environment and Science, and Senior Director on National Security Council staff. Welcome, and give us the wisdom.
And I was born in a log cabin. Thank you, Jan. And congratulations on this forum, and thank you for the invitation to be here. As Jan says, I'm at Columbia at a Center on Global Energy Policy, which is a new center here at Columbia where we're doing analyses of energy policy in the United States and around the world. It's a new center. It's about 2 years old, but we've been issuing a series of reports on topics as technical as the renewable fuel standard in the United States, which is a very detailed piece of law and controversial, to much more bigger picture issues. We are currently engaging in a big project on climate change in China, and looking at the Chinese energy sector and Chinese plans to address climate change. Released a report last year on shale gas in China. We did a report last year on African energy networks, and are launching a project now on exactly the topic we're discussing here on decarbonization. And we're looking in particular at the capital flows to the developing world for low carbon development. And my colleague Keith Bennis, who's right here, is working on this. And among the pieces of this project is we're going to private sector investors who are deploying capital in right now in the energy sector in the developing world, and asking them what they think would make the most difference in terms of increasing capital flows and reaching the targets that have been discussed in this conference already. If anybody here is an investor who is deploying capital in the developing world, we want to talk to you. Please let us know. Find us after this event. Or if you can recommend others who you think we should talk to, we're very interested in. And we hope that this will be of use to not only the negotiators in the Paris round of negotiations, but beyond. So my substantive remarks start by agreeing with Ian very strongly on carbon price. And the topic of this session is how government investors can work together. When I thought about that question, the first most obvious answer that came to mind is a carbon price. And nothing sends a clearer signal to the investment community more from governments than pricing carbon. It's already been discussed a fair amount in the session, so let me just make this comment about a carbon price. I think the world has a long ways to go on carbon pricing, but it is actually further along than many people appreciate, even I think many people in this community. China has got 7 emissions trading programs in provinces and localities which are underway, and has announced in just the past month or two that they're moving to a national emissions trading program. India has just announced in the past week a doubling of its coal tax. Now, a coal tax is not a carbon tax, but it's an approximation of a carbon tax. And so between China and India, you have close to half of humanity with something that's on the move towards something like a carbon tax. Of course, in the European emissions trading system, it's been in place for a number of years. I've never heard anybody say it was a perfect system, but this is a complicated issue, and bugs are being worked out, and let's hope that the ETS can work some of it out in the years ahead. We have Norway, we have British Columbia, a number of places where there are carbon taxes on the books, and even in my country, in the United States, we have essentially a carbon price in California, and one of a form in the northeastern United States in RGGI. And by the way, this is history, but we almost had one in 2010. And this is just a tale of the U.S. political system. Just to divert for a minute, I mean, I find it ironic, remarkable that in the United States in 2010, we had a majority of the House of Representatives supported a carbon price, and the Waxman-Markey bill, they passed a bill. The President of the United States supported that bill. If you did polling, a majority of the people in the country supported that bill or that idea. And if you counted the members of our U.S. Senate, more than half of the members of the U.S. Senate supported that. But it didn't pass. Why? Because of our filibuster rule. And so it's difficult to move these things forward in our political system, but I think there will be a chance in the years ahead. So I think a carbon price is important. The second thing governments can do is reduce fossil fuel subsidies. Hugely important. This is obviously a moment of opportunity for reducing consumer side subsidies as a result of low oil prices. We're seeing that in the Middle East, we're particularly seeing that in South Asia, where there's been a significant move in just the past 3 or 4 months to reduce fossil fuel subsidies on the consumer side. And I think there is going to be a move on this in some of the Middle East countries where fossil fuels are priced at a very low level. I think I'm getting a 1-minute sign, so I will respect that and be brief and come back on this. But I think the third most important category of things that governments can do is help bring clean energy technologies to scale. That the financial hurdles for deploying clean energy can be enormous. The valley of death for commercialization of clean energy technologies is significant. Programs that provide guarantees for commercial lending to help scale up clean energy technologies are hugely important to success in this area. So are programs that that invest public money in research and development. There's a market failure when it comes to research and development globally in terms of these technologies, and we need governments investing lots and lots of money in order to bring these technologies to the place where they can help solve the climate problem. So I have more to say, but I'll stop and come back to it.
Thanks. No, this was a great compliment, and indeed the subsidies, I think, are the additional thing which is very important to bring into the picture. So we're getting a more complete sizing of everything. Let me introduce briefly our next speaker. Shilpa Patel is the principal advisor at World Resources Institute. She focuses on understanding how to mobilize private capital for climate investments in developing countries, consults for a number of organizations on climate finance, and is principal advisor to the Finance Center at the World Resources Institute. She previously worked for a number of years at the International Finance Corporation, where she headed IFC's work on climate strategy and metrics. She also worked on sort of climate change impact of its activities and impacts of climate change on private business and IFC's operations. She helped launch IFC's first green bond and worked with institutional investors and stakeholders to define green bond criteria and standards. She doesn't come from a log cabin. She worked and got her degree at Wharton.
You stole my line. I was going to say I was not born in a log cabin. But anyway, thank you very much. So the World Resources Institute, where I work, is a global research organization based in Washington, D.C., which has about 450 experts and staff located in Washington and around the world. We organize our work around 6 critical areas that we think need to be addressed to secure a sustainable future, and it's worth reminding ourselves, whether it's worth it or not, I will remind you of what they are. So first on climate, I think we need to catalyze a global transition to a low-carbon economy and protect communities and natural ecosystems from damage that's caused by climate change. On energy, 1.3 billion people live without access to electricity. So sustainable economic development needs to be driven by affordable, clean power. The world's food systems need to be able to feed 9.6 billion people by 2050. In a sustainable manner with the least impact on the environment. Forests. Reducing forest loss and restoring productivity to deforested and degraded lands can help alleviate poverty, enhance food security, conserve biodiversity, and mitigate climate change. The 5th area is water, which is indispensable to life. And understanding water risk is going to be the first step in assessing current and future challenges. And then finally, 70% of the world's population, of these 9.6 billion people, is expected to reside in cities by 2050. So sustainable urban and transport solutions will need to be scaled up. So at WRI, we look at these 6 areas through 4 lenses, which governance, business, economics, and finance. And the Finance Center, where I work, focuses on shifting investment, both public and private, towards sustainable and climate-resilient development and away from activities that harm people and the environment. You can read more about our work and our research on our website, links to which are in the materials that Columbia has, the conference organizers have put together. But I do want to say that we have quite a bit of research that's relevant to the topic at hand, obviously seen from our lens of a research entity that is focused on policy prescriptions with a developing country perspective. So the topic of this panel is how investors and governments best work together. And I thought I would approach it based on what we see as the roles of the different players involved in here. So the first thing I want to say, and I think we've heard this and we know this, is that the private sector is key. Now, according to one estimate, around $5 trillion are invested annually in various productive sectors, in a business as usual scenario. So if we want to green these flows, an additional $700 billion will be needed. The new climate economy report, in which we were heavily involved last year, estimates that the world needs to invest $90 trillion in cities, land use, and energy systems between now and 2030. I think we can argue about the numbers because no one really knows exactly, and tracking climate finance has proven to be notoriously difficult. But I think we can probably all agree that whatever the exact number is, it is very large, and public budgets will not be adequate. So a big chunk of this money will have to come from the private sector. And so this means that the public sector, writ large, will need to find ways to attract private capital into climate-relevant investment. So then what should the public sector do? Well, I think for a start, the public sector needs to develop a better understanding of the private sector. Private sector is not a homogeneous entity. It needs to understand what motivates the private sector, what the private sector needs in order to invest. So quite apart from any climate-specific policies, there needs to be an overall enabling environment for private investment. So a whole slew of factors goes into this, from rule of law, enforcement, adequate physical and economic infrastructure. But there definitely need to be consistent policies and regulations for low-carbon development. We've heard about fossil fuel subsidies and carbon prices. It's definitely necessary. But there are other barriers to low-carbon development that need to be understood and addressed. And I think my point here is that governments do have a lot of tools at their disposal to bring these to bear to the problem at hand. But for them to do this, they need to have a climate agenda and need to take ownership of it and formulate plans in an inclusive and multi-stakeholder process. So this also means using international donor support strategically to address key gaps, capacity gaps, provide training. And there may be a case for using donor support to address transitional costs, but throwing money at the problem without addressing the underlying causes will not lead to a long-term sustained outcome. Now the private sector. They need to better integrate climate and more generally environment and social considerations into the investment decision process. What we heard earlier this afternoon notwithstanding, I don't think it is that uncommon for fund managers to have fairly narrow investment horizons. And I just wish owners of capital would use their considerable financial strength to bring about a change in investment practices, be it in investee companies or fund managers, or even putting pressure on governments, frankly, to adopt the right sustainability policies. I also want to say that short time horizons don't just plague the private sector. The public sector and the quasi-public sector also falls prey to a desire for quick solutions. Now, our research shows that successful interventions build upon many years of sustained effort, some of which may seem very incremental, but which do add up over time. We're looking at a few cases now and charting the various policy measures and interventions that have contributed to their success. And it is clear that consistency of purpose and focus have been critical elements. Let's just take the case of wind energy in Denmark. I think we can all say it's a success story, but we sometimes forget that it's a story that's been almost 40 years in the making. One last point, which is the role that development banks and donor governments can play. They can be sources of risk capital and act as a buffer between the public and the private sectors, and they can create innovative financial structures to mitigate perceived risk, perceived or real. Indeed, there are promising examples of such structures, such as first loss guarantees and other credit enhancement that have been successfully implemented and that hold promise for unlocking even more private capital. Hopefully, Vikram will speak to that in his remarks. But the final point I want to make is that no amount of slick financial engineering can compensate in the long run for an underlying lack of coherent policy. So let me stop there.
Thank you. Thank you very much. I think it's very appropriate to stress the time element, both in terms of transition, long-term agenda, and the short-term versus long-term horizon. The role of development banks, I think, is important and should not be underestimated in this context. Moving on, so Vikram Vich is the head of climate and carbon finance at World Bank's Group's Climate Change Vice Presidency. He leads the external engagement on climate finance and development of innovative market-based solutions to mobilize private capital for emerging markets. He's worked with several funds under management development, the Partnership for Market Readiness that supports countries wanting to put a price on carbon, and the initiative on the next generation of networked carbon markets. Until recently, he also worked with IFC, where he led the work on climate policy, climate risk, and adaptation. Has considerable experience in the private sector, in supporting financing clean technologies such as renewable power, waste to energy, fuel cells, and electric vehicles. His background is both in education at Indian Institute of Technology in Delhi and University of Maryland. Thank you for being here.
Thank you. Thank you. And a very generous introduction, pulling out stuff from way past. So, by way of introduction, in terms of, I still work for the IFC, the International Finance Corporation, which is the private sector affiliate of the World Bank. And together they are called the World Bank Group. So many get confused as to the difference between the World Bank and World Bank Group. So it includes everybody. And climate change is a very important topic for the World Bank Group. And for that reason, a unified sort of management and vice presidency was created that spans across all the World Bank Group institutions. And the reason for that is because addressing climate change is a priority, because we need to help both our business, government and business. The World Bank deals with public sector and governments, whereas the IFC deals with the private sector and businesses, so they can continue to grow and thrive in what is likely to become a very rapidly warming, or at least steadily warming world. The World Bank put out a series of reports called the Turn Down the Heat, and you just need to sort of flip through them to realize what the devastating impacts of unfettered climate change could well be, and the fact that all the development gains that have been made so far are potentially at risk if we don't address it. Our president, the World Bank Group's president's speech in December laid out the vision very clearly. It sort of converged around the fact that we need to move as quickly as we can to a net zero emission world before 2100. But this can be done. We are convinced it can be done in a way that enhances resilience and creates the growth opportunities and investable growth opportunities, which is what hopefully we'll talk about. And unlike treaties of the past, and Janos Pastor spoke about this, the Paris Agreement, and I'm sure we'll hear from Laurence immediately after this, it needs to speak very clearly to the economic imperative, much as it does to pollution or carbon emission targets. And this is the big transformation, I think, in terms of addressing climate change. And it needs to move from the environmental basis that it has been anchored into what is really an economic imperative now. So in that context, we support climate action, both the public and private sector, whether it's helping governments design regulations, standards, and policy, or to mobilize the private sector and leverage it in terms of helping support this whole low-carbon development pathway. Yes, we only work on emerging markets and countries, which makes it that much more difficult, and I'll come to that in a little while, in terms of the challenges with the institutional investor community. So with that, maybe I can, just one note, and in terms of carbon pricing, I'll talk about carbon pricing, but my colleague from IMF, Ian, and I agree to disagree that markets also play a role. From our perspective, we believe carbon markets are a fairly significant part of the carbon pricing mechanisms that could be deployed, and some successes are beginning to be seen around the world, but we'll talk a little bit about that. So in terms of sort of what are the challenges in terms of decarbonizing, and how can governments and non-profits, capital markets, institutions all work together? So let me start with governments. It's clear that markets need signals, and if you're going to decarbonize and de-risk investments, then in the face of climate change, then we need to address the uncertainty around the political direction, and we need to ensure that governments put in place stable, long-term, what our friends at Deutsche Bank were fond of calling TLC, which is transparency, longevity, and certainty, in terms of whatever kind of a set of policies which hopefully are smart and investment grade, that will ultimately allow the private sector, the institutional investors, and everybody else to act. So the problem with uncertainty is, and not addressing it, is that either the institutional investors hesitate, as we heard in the first panel, or it increases the cost of investment, because the whole issue around de-risking becomes a challenge with the unpredictability of how the future is going to unfold. So every country, I mean, this is, we're convinced, no matter what, is going to have to effectively manage its economy. And decarbonizing, you can look at fiscal policy, carbon pricing, fossil fuel subsidies, what we already talked about, green policy, whether it's feed-in tariff for renewables, performance standards for certain sectors, especially for energy efficiency, enabling environment for the investment, whether it is building capacity for banks and trying to develop the local capital markets. And that's something, again, I'll come back to later. And then, of course, aligning financial regulations with long-term sustainability. That's the focus of a lot of our work with the UNEP inquiry, which is also represented in the room. So, so we've seen this swell. Oh, my God, 1 minute. I thought, okay, quickly. We're down to, I thought we had 8, but never mind. So we have carbon pricing, huge momentum. The head of WBCSD came up in Lima and said, it is amazing how a absolutely dead topic has become resurgent. And we've heard it in the panel before. We heard it, everybody mentioned. It remains a very key tool. We have 1,000 businesses, 75 countries, 25 subnationals. We've heard of China. Korea's gone to an ETS, an emissions trading system. China is going to converge to a national one. Chile is putting a tax in place. Phenomenal, but it's not enough. And what we're going to need to do is accelerate this whole carbon pricing. So along with businesses, investors, others, this was sort of launched at the UNSG summit. CDP is in the room. We mean business, the coalition is in the room. The bank groups sort of working with all of them on something called the Carbon Pricing Leadership Coalition. And that's intended ultimately to help define the business case for carbon pricing. And so one of the things which I would invite the investors in this room is to sort of work with us as this coalition, and I see at least Nigel in the room, Nigel Topping is here, the carbon pricing scenarios are going to be developed. Yes, a lot of us may agree or disagree with what Bob Richmond said earlier today. From an economist's perspective, maybe there needs to be one pure, one global top-down price on carbon, but that's going to have its challenges by country, by sector, the impact. So we're going to have to develop what are fairly robust carbon pricing scenarios, and they're going to come out later this spring. So for those who want to sort of use this ultimately to help decarbonize their portfolios as risk management tools, we sort of invite you to do that. But while we wait for governments to put all these glorious set of policies in place, I think the investors can still do a lot more to address what is significant risk in their portfolios. We supported a study by Mercer in 2011 that said that climate change could constitute as much as 10% to the overall portfolio risk. We are now supporting an update to that study. I think it's going to get worse. I think the trends are there. And investors are beginning to realize it. We heard from them all, whether it's the Portfolio Decarbonization Coalition, the pledges in Montreal, the commitment by the likes of AP4 to shift allocation to low-carbon assets, or developing new products like green bonds that, in spite of Philippe's reluctance, have sort of taken off. And the bank and IFC have been sort of prime movers. I, in some ways, agree with him. I think we have not seen the real deployment of green bonds. We are still in 35 million deep. We are still billion deep. We are still experimenting. We are still trying to get the rules clear. We are still trying to educate. The real action will come, I guess, when we start to truly get into true mobilization, asset-backed, country-level, city-level type, project-level green bonds. Anyway, so the Mercer study is being updated. Its outcome is expected to sort of help investors shift their portfolio into low-carbon, climate-resilient assets. This is due out in May, and we are hoping that these insights will help inform the debate leading up to 2015. And if I can take 1 extra minute, I just want to sort of talk about where governments, MDBs, capital markets, private sector could come together in terms of developing potentially new products. We already talked about green bonds, but I think there's a whole need to de-risk and help institutional investors with the products they need to scale in order to be able to actually invest that famous 0.1%. It's the Holy Grail. And I've said this before, I just hope, like the Holy Grail, it's something we'll find, unlike the Holy Grail one day. and it's not like truly ephemeral like the Holy Grail, right? So we're working on a whole slew of things like aggregation warehousing platforms that will try and address the issue around shorter tenor debt that commercial banks can provide with the longer tenor, lower risk debt potentially that institutional investors can provide. How do we bridge that? So we are sort of looking at that. There is no shortage of money. 0.1% is $100 billion, right? So the question is, how are we going to deploy it? Where's the absorption capacity in emerging markets? Where is the deal flow in which ultimately has to come from emerging markets? So we are focused on that. How do you help project preparation? How do you provide technical assistance so that ultimately it links to investor funding? One example is the Global Infrastructure Facility that was launched recently. It's an open platform for government, MDBs, private sector investors to sort of come together and helping structure sort of complex projects and ultimately insured flows. Issues like political risk, which the likes of OPIC and MEGA, which is another World Bank Group affiliate, address. But what about things like local currency risk, which is huge in terms of trying to address some of these issues? These are not available for longer tenors. They are not available for the kwachas and the other exotic currencies in the world. So we are working both under the sort of broader auspices of something called the Innovation Lab for Climate Finance, but also leveraging sort of the work the IFC Treasury has already done in terms of swaps and hedges in providing, actually issuing local currency bonds in order to ultimately finance these. And then I think it's crucial to work with investors in emerging markets. And that's another call to the institutional investors in the room here who talked about it. There's huge synergies across the private sector, across the financial sector, whether it's banks, pension funds, regulators, insurance, capital markets, advisors. Can we look at North-South partnerships? There was talk about Europe, America. There was talk about Europe, Australia in the first panel. But club deals or North-South, can we do that in the North-South context so that pension funds from North and South could sort of connect in a way that allows this money to flow? So I think I'll stop there. And I think the ambitious deal in Paris is ultimately what we all need, with the right signals, the certainty, because it's the only way we are going to send the message to the investors that this is going to be profitable, and it's profitable for the long term in pretty much every sector of the economy that my colleagues have already talked about. Thank you.
Thank you. Thank you, Vikram. I think this is very much to the point in terms of the different scenarios, the way investors can address risk and how to collaborate both at the sort of overall level as well as the local level, the project preparation that you're mentioning and so on. And it's always interesting to hear the IMF versus World Bank intramural competition of ideas. It's very good. So our last but not least speaker is Laurence Toubiana, who is a special representative of the French Minister of Foreign Affairs, Laurent Fabius, for the 2015 Paris Climate Conference, and also French Ambassador for Climate Negotiations. She is the founder of the Institute for Sustainable Development and International Relations in Paris. She's also professor and director of Sustainable Development Center at Sciences Po, sister institution to Columbia in France. And she serves as co-chair of the Sustainable Development Solutions Network, Leadership Council, and co-chairs that institution's working group on deep decarbonization pathways. She's also president of the Board of Governors of the French Development Agency. And she is a person who can proudly say that she's founder of a journal, and the journal is Le Courrier de la Planète. She has published a huge number of articles based on books on environment, development, international issues. It's a pleasure to have you here.
Thank you. It's quite easy to talk after this very complete and bright panel. Because many ideas are converging and by the way are very useful for the time to come. I may want to, in a way, divide my talks into two elements. One is what is the current discussion between private sector and public sector on how they work together, and see, in a way, what the recurrent argument on the two sides, and see, because there are, of course, elements of the political economy in each country that may prevent or facilitate the thing. And then because of these political economy concerns, to see if the process that will bring us to Paris can help this and help in a way overcome the traditional obstacle of credibility, previsibility, longevity, and certainty, which is normally what the private sector is asking from the governments. And see what we have in hand in Paris that can facilitate that. So basically, first point, yes, the discussion is what you have been describing. What I think and I see in many countries is this, even if the private sector is demanding for such signal, many times the same private sector is fighting against the signals. And it's particularly true on the reform of the tax system, on the removal of the subsidies, and even on the investor side, we have here very progressive investors in the room. When you talk to others, even recently this afternoon, I will not give names, some say, yes, but if we support, for example, the carbon price campaign of that the World Bank had launched, then we are signaling to part of our portfolio that we don't like them, we don't support them, we are in a way disinvesting for them, and we cannot do that. So there is really a problem of political economy in each country and probably more globally that really prevent this to happen, even if the consensus in the and I think the consensus is even broader, that we need these signals to happen. As Shilpa said, it may be not enough. We need even much more long-term signals, but again, I would just develop what we can probably build in Paris and embedded in the agreement that can help overcome this difficulty, which we know all of us, and including in my country, where to put a carbon tax is something like a drama, and we have everybody on the roads if we want to put it, and then some countries succeed because of the better political context, some countries no, and this is not providing this previsibility, etc. So why Paris can help that? I think what is important is a public sector, private sector discussion. Within this discussion, we have to build this new or the follow-up or the evolving climate regime, is that on part one, we have an agreement that would define the rule for everybody. And we can do something in this agreement that can facilitate and foster this process. And we have the process of independently national determined contribution, which, because of the name, you feel how much this is distancing for any top-down process. INDC just won't say, we are sovereign, we want to decide our policies, don't mess up with what we want to do. So based on these two elements, I think what is good is that at the same time, we will discuss the rules of the system, and in particular this national contribution. And the rule in the system would say, more or less, you have to commit to emission reduction and to adaptation. Probably we will have a broader sense of the contribution now, but you have to explain how you do that, and what are your policies behind this. And that is the first step. I think countries are, and because you all have said, and particularly David, show how many countries are building, or Shilpa said, how many countries have built climate policy in there and are beginning to, sometimes they start, but they are there. So we will have, at the end of the year, probably before, most of countries during the summer, a sense of what the policies are pointing to. And we will see effectively, I think I agree with many of you, that we will have some kind of price signal embedded in how countries get to their emission target reduction by 2025 or 2030. So this is important. I will add something that would resonate with what Shilpa was saying. We should insist on having countries not doing that maybe in the contributions themselves, but having a long-term view of what their scenario of decarbonization can be, because that is about constructing the visibility, at least of the intent on the investment plan, on the signals that finally at the end of the day would build in that credibility and longevity. It's not about the sort of the set of targets will build only the credibility. Is about how the countries imagine that they have to go to a much more deep decarbonization that the first range of INDC would produce. So I think if we can have this in the agreement, that is, we have to revise regularly the contribution, we have to have the long-term vision. It's good that the countries explain how they do that, what are their investment plans. Then we have a structure that we can begin to work in how we can align then policies based on this framework, which is independently produced indication of what the policies can be. So that's in the agreement in the INDCs. That's a matter of assessment of them and review and exchange of what the policies. We'll see I see deeply that we will see some kind of alignment of policy like we have ever seen in the global economy since the 80s. You look at trade policy, you look like exchange rate policies, with or without conditionality. We have seen a lot of alignment of policies in past years. So I do think that with this exchange knowledge process that I think is embedded in this discussion, we'll see quite naturally a realignment, an alignment of policies that may come more quicker than we anticipate. And I take that this carbon market was actually a very good example. Feed-in tariffs everywhere for renewable energy was a very good example. So disclosure, discussion, review, assessment, whatever form it takes, will push for a certain convergence on policies, or at least I am maybe a little optimistic, but I think so. Outside of the agreement itself, which is what we call our solution agenda, which is finance on one side and all these commitment of non-state actors, the vision we'll have is that basically in the summer we'll face a assessment that the INDCs that are on the table would not add up to a 2 C trajectory. This will demand a response, a clear assessment, acceptance of the fact, which is quite obvious, but then prepare a response to this. And the response is very much on what can be brought to the table additionally to accelerate the movement, accelerate the transformation, and a lot is related to a number of voluntary commitments that can help that. Carbon pricing is one. R&D policies and investment are in the second, and in my view, very important as well for the investors. If there is clearly policies of research and development and deployment together with private companies that can give a sense of where the sectors can be developed, I think we will see financial innovation taking place. And that could be this voluntary part that come on support of the agreement and on this minimum, the floor, what I consider the INDC should be. So this, in a way, could bring a new, more positive framework to this relation between public and private sector, with a view that in the way the government then could get more courage to do what they have to do, which is absolutely the problem today. We need them to have more constituencies supporting the transformation. That's why these voluntary commitments, the engagement of you as investors, can bring this process of review, the contribution more in a better sense in really designing the adequate framework. But I think that dimension of time, which is the shorter term and the longer term perspective, is for me essential to, again, build in the credibility perspective, which if not, will not be there, at least at that stage. So Paris should be, the outcome of Paris finally is exactly what Vikram said, is about sharing expectation and having the economic signals right. And this can come with a number of signals, not one. We cannot have one. We will not produce one global carbon price. It may not be the good solution, by the way, but we need to have this alignment of the signal as well. But I would have a little more time to develop this at dinner. So I'll stop there.
Right. Well, thank you. Thank you very much. I think this was excellent, both the optimistic view in terms of what we'll see over the summer and the overall alignment of policies coming from that, both inside and outside of the agreement. And definitely I agree the governments need more courage. That's for sure. Why don't we now move on to the question and answers? I suggest we collect several questions, and if you want to address them to specific panelists, fine. Otherwise, generally to the panel. As you're getting ready over there, I'll ask the first question or issue. I think it would be interesting, having heard from the various panelists, if you could address in a way where you would see the priorities. You've identified issues and in a way you've hinted at priorities, but what would you consider to be the highest priorities, both in terms of the danger of gradual sort of degradation if steps are not taken, as well as the kind of break or catastrophic possibilities which may happen with low probability but catastrophic events, and what would you sort of suggest one should take there? I think we had a hand up there. Do we have a microphone? Yeah, perfect.
Hi, Marcy Smith with the Responsible Endowments Coalition. My question, I guess, has two parts. It's about the U.S. policy context. I'm really pleased to see this panel at all, because with the Responsible Endowments Coalition, I work with a lot of students who are engaged in endowment campaigning and who are focused on climate change, and this, thinking about the role of government action is something that can't always be assumed will happen on its own. So I think this is a really vital conversation. But when we're talking about carbon pricing in the U.S. context right now, the hope of new legislation seems dim at this point, and so I think there's a lot of enthusiasm right now around the Clean Power Plan, and I am wondering what thoughts are on the panel as to what to expect with the Clean Power Plan, and particularly for investors and for corporations, what's their role in pushing for a robust Clean Power Plan? Because I do think that the EPA is, it's a bit of a political third rail in much of the United States. And while people can sort of think about legislation, you bring up the EPA and it brings up frequently pretty negative reactions from people. So if, the difference between regulation and legislation, right? So thoughts on that. And then also the role of the U.S. state in potentially just transitioning, its own infrastructure, its own vehicle fleets, its own buildings. It controls a third of the U.S. economy. So what is its role as a consumer of energy, as a consumer of products, in making the clean energy transition?
Thank you. Next one. All right. No. Okay. Well, let's get to the panelists. You can also react to each other, by the way. That's part of it. So let's go to Ian and go around, and we can have another round of questions. We still have time. Yeah.
Well, just the priorities for us to get a broad range of countries, particularly the large emitting countries. Doesn't matter whether low-income, small emitting countries price carbon or not for practical purposes. For the time being, the issue is to try and get a broad range of large emitters carbon pricing, and just getting the policy infrastructure in place. I mean, we don't anticipate that large emitters are going to be pricing emissions at $40, $50, $60 a ton within the next few years. So, I mean, there's legitimate debates over the appropriate level of carbon pricing, whether it's $35, $40 a ton or much higher. But for practical purposes, it's just getting a price on carbon, whether it's 15, 20 for now, and we can worry about jacking it up over the longer run in response to future scientific evidence. But just having the architecture in place is critical. And then for us, just getting finance ministers much more engaged in this issue. We don't think they've been sufficiently engaged up till now. But for us, carbon pricing isn't rocket science. It's just a simple, straightforward extension of what most governments are already doing. So getting that message across that we already have some of the administrative infrastructure in place in most countries. We're collecting charges on fuel use. We just need to cover a broader range of fuels, and we need to align the tax rates to environmental damages. For the United States, we hope that in the medium to longer term, clearly there's going to be a mounting fiscal pressures with the projected growth in government spending outpacing growth in revenues. So there's going to be a looming budget crisis in the medium to longer term. So and to solve it, we have to presumably cut back spending some, but clearly we're going to need to expand the revenue base. And at that point, when there's serious debate about expanding the revenue base, we hope that a carbon tax will be front and center in those negotiations. But for the shorter term, it looks like the main prospects of a regulatory approach through the Environmental Protection Agency. In this regard, we think that what we call a fee-based approach would be attractive. So that would be where power companies, you would levy charges on relatively emissions-intensive power companies and provide subsidies to relatively clean power generation companies. But that's a market-based approach which would provide broad incentives to switch to cleaner power generation fuels without a big impact on electricity prices. We think that type of pricing approach would be a more flexible response rather than a regulatory approach which might be more restrictive for firms.
Thank you.
You asked about U.S. policy. First, about the Clean Power Plant rule. I think the prospects are very good for the Clean Power Plant rule. President Obama has said that, and his staff has said it's going to be released this summer. It will apply limits on carbon dioxide emissions to existing power plants for the first time in this country. The coal power plant sectors, we're talking roughly 40% of emissions. And relevant to this conversation, it's already affecting investment in the sector in a very significant way. So I think there'll be a debate about this going on a long time, but it's already having an important impact. I think it's very important. I think then you asked about federal government leadership too, and I think this has been a big priority of President Obama's, and actually some presidents before him. That I think your figure on the amount of the economy the federal government occupies is high, but still it is. Our Defense Department is the largest consumer of energy in the country, and in a month actually, right? I think possibly in this room, we're going to have the U.S. Secretary of Navy who's coming to talk about everything he's doing in the Navy. It's been a major priority of his to reorient the Navy around clean and green energy. So there's a lot of work underway on that. You asked about priorities. I recommend focusing on bringing clean energy technologies to market and to scale. I think that's a place that governments can make an enormous difference. I spoke a little bit about this quickly in my remarks, but we need everything all along the investment chain, and we need governments playing a role from basic R&D, where there's a significant market failure and where we need to be investing in the next generation, to scale up to particularly the valley of death and commercial deployment, where loan guarantees and other types of credit enhancements can make a difference and beyond. And I think we've seen financial innovation make a big difference in clean energy deployment in just the past couple of years with innovative solar leasing models. I think an important question, which a number of financial innovators are looking at, is can you apply that model in other areas? Can we apply financial innovation with respect to energy efficiency in the same way? Can we do it with respect to deployment of LED lights? And I think governments have a role in helping to move that along, and that ought to be our priority. Can I, before I give up the microphone, also thank our panelist, Laurence Toubiana, for all the hard work that she's doing on behalf of her government and the world here. I think I was just thinking as you were talking, Laurence, I think I've seen you in 3 continents in the past 4 months, if I count correctly. And I know I'm coming back to Columbia and resting in between that, but I'm not sure that you're going back anywhere to rest. So thank you very much for all you're doing, and I know you've got a big year ahead.
Indeed, very bionic, indeed. Yeah. Shilpa?
But I mean, I think that in terms of priorities, like you say, I think that certainly if there isn't country ownership of a climate agenda, then I don't think things will get very far. Mm-hmm. So I think that I would say that the biggest priority would be to try and build that sort of ownership around a climate agenda. And hopefully the work leading up to Paris is going to set that give impetus to it. And on the U.S., I mean, one of the things that, well, I'm feeling very optimistic from what I heard earlier this afternoon, which is the shareholder activism or the power of the investment community to bring about change. I think that can really go hand in hand with regulations or other policy sorts of measures.
Thank you, Vikram.
Thanks. I guess I agree with Ian, so I'll start with agreeing with Ian this time. Yes, I think this needs to move to, if in the public policy realm, it needs to move to more engagement with the finance ministers. However, I can't resist teasing him because his example of the utility-based non-regulatory approach sounded very suspiciously like a market-based mechanism, but never mind that. But what I would say the priority is, so carbon pricing critical, yes, but I think we need to anticipate it. This is, as I think Florence herself was alluding to, Paris is going to deliver the framework. This is not about the road to Paris. It's about the road through Paris and beyond. We need to ultimately look ahead and see how we're going to create, and again, I'm addressing more the theme, the investors in the room. How do we create more scalable investable products for them? There is no absorption capacity for the kind of money they can unleash if we get lucky with them and successful in all the efforts they are doing. So I think we need to pay a lot more attention and focus on building that deal flow, so to speak, in emerging markets, the capability for these emerging markets, and which ultimately will help de-risk what is currently perceived as a much more riskier segment to get into. The risk, and this is the other priority, I think, is resilience. Climate resilience to climate change is very, very important. It's not there's no obvious business model for the private sector in this. It's based on avoided cost. With the discount rates any pro forma uses, there is no incentive for the private sector to invest in resilience. So once again, potentially, shareholder activism, institutional investors can drive this because it's important for them to have their infrastructure investments, to have their investments that depend on supply chain, agricultural-based, commodity-based products, all of which are subject to it. So if they start looking at it from a resilience angle, so the green, great, low carbon, fantastic, but independent of that, I think resilience needs a lot more immediate attention because I don't think we're going to hit that 2 degrees C in a hurry pathway, and I think we better start preparing a little more urgently for a warming world.
All right, thank you. And last but not least, Laurence.
Thank you. What could be the priorities? I think stating that, and I hope we will see that in many of the contribution countries really embarking on really having the price better, if not totally right, quote unquote. I think we have to rely as well on many regulatory instruments that are very helpful. I think about some where really carbon price would not make it anyway, because there is too much inertia in the system, particularly in infrastructure. I think building codes are very important. Fuel standards, for example, are very important as well. Market creation, which is basically public procurement or even creating the carbon market, that is all about regulation. And we can add, of course, the financial regulation we are talking about, and we'll certainly develop more in the conclusion and during the dinner, where we need to have this the investment in the long term with a little sort of a better financial regulation around it, because that's already there is really a problems. I do think that we have as well facing the information failure about research development that I think David was referring to. I do think that we have to, and in Paris my sort of dream would be to have a clear view of what are the investment the private and public sector are making in a number of technologies, and to know what are their technological roadmap, what kind of costs they anticipate in the future, because we have really facing for all the investors this failure of information. What is a technology in 2025 or 2030 would look like? We don't know. Well, we could know because many actors are betting, many actors are investing, and the sheer amount of investment is a good revelation of where the preference, the view, the vision is. I was struck by the Japanese strategy on having technological roadmaps with a clear view of where the technology will be, at least their vision, and the cost. In particular on the hydrogen, where they are very strong at that. If we have this, it's not about committing to new thing in part. It's about revealing the information that is embedded in the companies and the government strategies, and to see what is the result, what is the picture this is the landscape of technology. I do think that on one side we need more, as David said, intervention of government along the innovation chain, and we need to provide this information for the broader community of government, investors, etc. That would, I think, change. And I feel this very strongly because, again, I worked with the different teams working for the government to prepare the INDCs in many countries. The technological assumption by 2035, 2040 is totally different. And we are in a global economy. How can be cars totally different in 2050 in China from the cars in US or in Europe? They will not be. But when you look at the scenario, they are totally different. So we need this. There is clearly an information failure there. And I think that will be very important. And finally, of course, I think that's very important. I think Vikram referred to how we can bring the financial institution of the emerging countries on board on financing the low carbon economy. The infrastructure bank of China, the BRICS bank, how we engage that discussion. I think that's very important. I don't have any recipe, and I don't know if we can engage them by Paris, but certainly after we need them on board.
Very good. We have about 7 minutes. If there is a burning question, there is one. Okay, very good. Do we still have microphone, David? Perfect. And we have room for one or two more if there are people who have in the meantime formulated their thoughts.
Hi, Ophelia Harten from a private pension fund. What can we do in countries like mine that has strict limits and regulation in terms of returns and not too many opportunities or we don't have too many options to invest in low carbon or green funds, for example. What can we do?
Okay. Any other questions? There is one over there.
My name is Huifeng Chan. I'm from CICC, the Chinese investment bank based in New York. And I have to, before I ask a question, I have to give you the background. I guess many of you saw that in China, about 2 weeks ago, there's a long, about 2-hour video came out about the air pollution, the smog problem in China. Within a few days, there were more than 200 million download viewers, myself included. Okay, so that generated a huge discussion, debate on the social media, WeChat, and on many Chinese internet website. But we know that several days ago, the Chinese government, afraid of too much debate on the topic, so they banned all these video. So we know that the smog problem is China's local problem, and it is there, and it's killing people. Okay, and the global warming problem is everybody's problem, and it's not that it's going to kill us within a year. Okay, so when I am hearing that your discussion, my question to every person on the panel is that in the past, when you or if there's any happen, you meet with the regulators on the similar topic, global warming from China, or even some institutions. What is the general fear you have And also, do you see that, you know, the Chinese government is working with the international community on the global warming problem, or it's more or less just the gestures? So it's a very much open-ended question. You know, when I was talking to a lady from CDP, and she told me that the organization has opened an office in Beijing, and I joke with her that you should put 80% of your global staff in Beijing, because that's where the problem is. Okay. So anyway, I'd like to hear from you guys. Thank you.
All right, thank you. Is there one more intervention? If not, we'll one more. Okay, very good. All right.
The 2016 election.
Remember, we have some room in the cocktail during the cocktail party as well. So I'll let the panelists address any one of these problems, if you'd like to.
Well, just on the China issue, I mean, you know, we'd recommend a charge on fossil fuels in proportion to the carbon content, which works out $35 per ton would be about equivalent to roughly $3 per gigajoule. We've also, for China, we've got some rough sense of the air pollution damages. We put those at about $12 per gigajoule. So for China, an awful lot more severe than the carbon damages, because China's rather unique in having very high population density and hence a lot of population exposure to the emissions. So we'd recommend two components to the charge on coal use, one for the carbon and one for the air pollution damages. We think charges are much better than regulations, because charges, with the caveat that for plants that then adopt control technologies, they get appropriate rebates. Or alternative, so you can levy the charges up front on coal use, but then provide rebates to companies that adopt control technologies, or if it's administratively feasible, you can levy charges on the emissions coming out of the smokestack. But we think that's a much more effective approach because it exploits all of the potential behavioral responses for cutting emissions. So not only rewarding the adoption of control technologies at new plants, but also rewarding the adoption of retrofitting, adopting control technologies at old plants, possibly, if it's possible, shifting from high sulfur to low sulfur coal, shifting from coal towards natural gas and renewables. And also, as these charges are reflected in electricity prices, that helps reduce the electricity demand some, and also helps reduce emissions. Whereas the more common approach is just to require that new plants have control technologies, which gets at one of the behavioral responses but not the others, and also may have perverse effects in terms of retarding the retirement of older, more polluting plants. So we think that this pricing approach is much more effective than a regulatory approach. So that's what we'd be recommending: a separate carbon charge on coal use and a tax on coal to account for the air pollution damages, with rebates for the adoption of control technologies.
Thank you, Ian. Anybody?
Yes.
I was going to try and address I didn't catch the name of the country where you went. Oh, Peru. Okay, good. My example was from Peru, so good. This will work well. Thank you. So two things. One is supported, coming out of the G20 work, we've been supporting leveraging the early, IFC had supported the South African pension industry, for example, to deal with the entire ESG regulatory sort of framework, which would then allow them to start looking at how the regulation allows the pension funds to invest in ESG friendly, but ultimately also low carbon. So under the auspices of the G20, we are leveraging some of that work into some other countries like Colombia, Kenya, Indonesia. And we have a lot of work going on with banking regulators around green credit policy. So there's a lot of that work that we are already doing, which can help the countries and the pension regulators get hold of it. In terms of products and in terms of the ability to do that, I think till that regulation actually starts to shift, there are ways of actually providing that kind of. The example I was going to give you was IFC issued a small but still relevant $15 million bond in solas, green bond, expressly for a Peruvian insurance company who wanted a green bond in its portfolio. And we structured it expressly, so we swapped it out because at the end of the day, but it was designed so that this RIMAC, I think we can talk about it separately. So stuff like that can be done with MDBs and other relevant sort of balance sheets, if you will, to help create products for in-country, where regulation would obviously fit with that because we are AAA, for example.
I'd like to come back to China. The WRI is working with the China Council for International Cooperation on Environment and Development. And this is a high-level task force on green finance that's trying to look at green financing reform and the promotion of green transformation. In other words, a lot of it focused on energy efficiency, for instance, with the banking sector in China. So, and it's a high-level advisory body whose recommendations will go straight to the Chinese Prime Minister. So I think there is a lot of genuine interest on the part of China to address, its longer-term environmental issues.
I can coincide on Shilpa. I'm a member of this panel, and yes, the consciousness and the awareness is growing. But of course, there are a lot of political difficulties in China too, meaning a number of instruments have been tried, sometimes not efficient enough because there was a lot of the sanctions were not applied or they were too low. For example, the tax were too low, and so there is a bigger it's a very, very vivid and very strong political debate nowadays in China. So. And we may be afraid of, because this dimension of local pollution, global pollution, which sometimes coincide, but sometimes not. And you may know, and I'm sure David knows about the project in China of, how do you say, liquefaction? Turning coal to gas or to liquid, just to avoid local pollution. But then this is, of course, much worse in terms of energy efficiency and emissions. So it's good because, in a way, you take now every seminar in China on low carbon economy or climate. They will begin by photos on the pollution. All the Chinese scientists would do so, the experts, the professors, then going through from the cost on health, public health of that, and then go to this is making the case for climate policy, but in reality is not coinciding totally. And of course, that's what the first speaker referred to. You can have a pollution tax that doesn't do a CO2 tax. So there is a concern there on the choices and the political pressure to get cleaner air in Beijing. We can fit or not fit with a more global, reducing global pollutions. How much a government would. It was, of course, very interesting to see what the agreement between U.S. and China on the notion of a peak year of 2030. It's still, of course, we would like to see more, because China is a very big emitter. 2030 just depend on the level of it peaks, by the way. That's, I think, the major question. And I understand that very recent declaration of the president of, I don't know exactly the source, so I have to check. It was just today new about the reducing in absolute terms the coal consumption next year and the following year until 2020, meaning that we have to check that there is already the notion of a peak on coal consumption already there, not by 2020 but much earlier. If these signals converge and if we can in a way allow for a ratcheting up mechanism in the agreement for China to come along with better policies in the future and better contribution, I think we could take very seriously the new engagement. There are a lot of signs, positive signs, but of course it's a complex country. Public companies have been not performing so well. It was a lot of command and control to bring them more in line. So I know it's a very big question in China, and the growth rate is part of the discussion too. So how we can engage on a more sort of stable discussion with China is protecting or respecting the sovereignty, which is really a key issue, and at the same time engaging in the reforms. That is really very tricky, and of course all the agreement is about China in a way, and they know it, and they play well in the discussion for the moment.
David.
I had dinner in Beijing a year ago about in a cold winter day, and I was talking to the waitress and told her that I was going down the next day to Hainan Island, which is in the South China Sea, a beautiful tropical place. And she said, "You're very lucky." And then she said, "There's no PM 2.5 in Hainan Island." And I had two thoughts about that. First, it was amazing that she thought I was lucky, not because I was going to a place that was warm, but because I was going to a place that didn't have any air pollution. And second, that PM 2.5 just rolled off her tongue. I mean, I don't think there are, many people in the public in the United States who know what PM 2.5 is. But as you were pointing out, Sarah, the issue of local air pollution is a top-line political issue in China today for obvious reasons, because it's tragic what's happening there. And in terms of the global warming agenda, the good news is that almost everything that one can do to fight local air pollution in China also fights global warming and reduces CO2. Not everything. And there's one or two directions that actually work at cross purposes. But I think those are probably not priorities of the Chinese government. So I think the major steps that one can take to fight local air pollution in China, which have tremendous momentum behind them, are also steps to fight global warming. I think the agreement between President Xi Jinping and President Obama was historic in this regard. And I think from my understanding of Chinese leadership, they don't, in general, make high-profile public announcements without a fairly serious intent to follow through on them. So I think that's good news for all. I just wanted to close by recalling a comment that Laurence made in her first intervention. She was talking about talking to investors this afternoon who don't agree with this agenda, if I understood correctly, or are not yet on board with the discussion that we've had this afternoon. And I think that might be a useful jumping off point just for closing, because this has been a fantastic conversation. So I want to congratulate everybody who's been involved in organizing. It's been really productive. But at the same time, no one ever changed the world by preaching to the choir. And I think if you look back at I was just thinking, somebody on the first panel mentioned the gay marriage issue, and that's one I followed fairly closely. And gay Americans didn't just talk to themselves or even progressive allies. They went into the conservative movement in the United States. They recruited, ultimately, the lawyer, George W. Bush's personal lawyer, represented the gay advocates in the Supreme Court. And we've just had, if you follow the media, really reminder of the civil rights advocates and how they, 50 years ago, went out and confronted the people who disagreed with them. So I think that's a really important part of this discussion. There are some very strong voices on the other side of this issue. I don't happen to agree with them. But I think all of us, this has been a really tremendous discussion in terms of pulling everybody together and thinking about these arguments. And I hope that then we'll engage more broadly going forward.
Well, thank you very much. Why don't you join me in thanking the panelists for providing exciting food for thought. And we next have one of our most exciting faculty members, Patrick Bolton, giving us our concluding remarks. Should we stay, or what do we do? We sit.
Stay
we
there,
don't
yeah.
move. Okay.
So
I should suggest, if nobody's going to introduce you, I should say a few words. Those of you who don't know Patrick, he is one of the really leading world economic theorists, and he is distinguished in addition from that he is among them one of the few who really do tackle real-world problems, as this conference indicates. He and Fred and others have been instrumental in bringing all this together, and so it's more than appropriate for him to give the concluding remarks.
Thank you, Jan, for these nice comments. So I have the difficult task of concluding this event and keeping everyone from having a cocktail. And it's made all the more difficult that my first line, David just stole my thunder. I was going to say, preaching to the choir, preaching to the converted. You always worry about that. So is this another event where we're just preaching to the converted? And I would emphatically say no. And I think that just the turnout that we've seen today, the interest in the debates, shows that the ground is moving, lines are shifting, and there's new excitement. And I think in large part this new excitement is coming from the climate summit, the initiative taken in the climate summit by UN Secretary General Ban Ki-moon to engage with this really major change, engage with the private sector and investors in this very important policy question. So what I will try and do is pick out some of what to me were the most important points that people made, and then I will just conclude with thanks. So in the interest of time, let me just jump in. And I want to underscore what David Pitt Watson started out saying, which is that climate change is the most important issue we're facing in the 21st century. I think that is very true. And it's important to remind ourselves of this fact. Now, David continued and used the interesting term about financial markets, that they're institutionally fossilized. My pronunciation is not the best, and I think that is very true. It's what we have discovered, I think, far too late, is how not only little attention there was to the climate issue in financial markets, but how also the institutions and the markets are biased against picking up this enormous risk. Now, a third point that was brought up in his introduction was a third question, which I should say, is who is the gaffer? And I thought this is a particularly apt question for us in this room. He went on to say, well, there is no gaffer, but we are all players, we're not spectators. And I think this is very important. And I think this is what makes this an important event and why we're not preaching to the choir. I think what we've seen is we've seen very different perspectives, very different expertise. We've all learned from each other. And that's how we're going to go forward. And that's how we're going to bring in the skeptics and the people outside this room. Now moving to the panel, to the first panel, I picked up, let me start with what Anne Stausball said about CalPERS, and what I thought was very important, and that is, these are the terms she used, that climate risk is perceived by CalPERS, taken by CalPERS as a very significant material risk. I think that's very important to keep that in mind, and I hope that this perception, this analysis will be much more widely shared in the near future. And then the other point that Anne made, which I thought was very important, was the point about CalPERS signing on to the Montreal Pledge on disclosing CalPERS carbon footprint. And she made a very effective point saying, you need to practice what you're preaching. And I think this is a lesson that we should all, or at least fund managers should all take on board. Moving to Philippe Desfossés, who was the second speaker on the panel, he made the important related point that pension fund managers should see climate risk and analyzing climate risk as their fiduciary duty, doing something about climate risk as their fiduciary duty. And he mentioned what his fund is doing in this respect, I think a very interesting and very promising direction on the portfolio policy, which is the best in class. What he mentioned, the best in class analysis, which has very good properties. It it's probably one of the most effective risk management tools, and it also has it sends a very strong message to companies that are being considered to be included in a portfolio. Now, moving on to Bob Litterman, he's an economist like me, and the first thing that economists say about climate is there's a missing market, and that's very true. We are not pricing emissions correctly currently. The adequate price should be more like $40 per ton than zero today, and that we're in the meantime wasting a precious, scarce resource, which is clean air. And then Bob mentioned a very interesting step that WWF took, the total return swap, to try and mitigate the risk with respect to stranded assets in coal. And he also emphasized very strongly his engagement in a policy to introduce a carbon price for aviation, a global carbon price, which I think is a very interesting and important initiative. And I'm hoping that this meeting will lead to a continuation and emphasis in this direction. Then moving on to Edward van Gelderen from APG. He was the first to bring up, I thought, a very important point about engagement, that we're here for the long run. We have to engage with the carbon emitters, not just today, but for the foreseeable future. They're not going to disappear right away. And he described important steps taken by APG in this respect. If you can still bear with me, I still have maybe 3 or 4 points to make. So moving on to Magnus Eriksson from AP4. Now, AP4, now Frederick and I have been engaged with AP4, and we've written a discussion paper that you probably found outside on hedging climate risk. So what I take away from what AP4 has done, and I think a very promising, important direction, is bringing in the index providers, and having the index providers offer decarbonized indices. That is super important, because in the fund management industry, incentives are all about benchmarks relative to indices. Now that these decarbonized indices exist, you can start benchmarking performance relative to those indices for your financial manager. And that, I think, is going to unlock an important obstacle. And moreover, as he pointed out, what is really attractive about these decarbonized indices is that if you hold them, you're holding a free option on carbon. Because currently, carbon isn't priced adequately. It will be in the future. And if you hold this index, you're basically benefiting from a free option. And in this respect, another point I want to bring up that was made in a slightly different context. At some point, someone mentioned, well, what we need is we need a committee of experts like the FOMC for monetary policy, deciding on interest rates. We need something like that for carbon prices. And I thought, yeah, that's a very good analogy, because if you think about FOMC today, if you think about what where monetary policy what monetary policy has become today at the Fed and other major central banks, it's all about managing expectations. It's all about what you say and how what you say influences expectations. Now, what we're doing here is exactly the same, can have exactly the same impact. The more we talk about the coming carbon prices, the more we're influencing expectations, and we're moving markets already today in anticipation of those policies. And I think that's where the interaction between private sector and public sector is very fruitful. So I may not have time to cover all the other points. I'm very sorry. And let me perhaps move to the second panel. I've been talking too much about the first panel. And I wanted to pick up on an important point we heard from our first keynote today, Janos Pastor. And actually, it was about this point about managing expectations. And helping negotiators in the process in Paris. Now, the first speaker on the second panel, Ian Parry, brought up, in my view, a very important point, so it was only brought up in passing, but I want to underscore this. It struck me as particularly important, and that's the IMF's technical assistance to help countries remove energy subsidies. I think this is extremely promising, especially in the current context, low energy prices. It's almost worth, putting all your chips on that policy and engaging with the country, particularly the countries that are currently not demanding this kind of technical assistance. Now, David, I've already mentioned earlier, stealing my thunder, but he brought up another related, very important point, I thought, and that is, the role of governments in bringing clean energy tech to scale. This is very much a super important and probably high payoff policy. And it's probably one of those areas where, particularly in the US, my view is this is probably going to face the least political opposition. And so that will be extremely promising. And turning to Vikram Vij, I hope I'm pronouncing your name right. He just thought, something that I picked up on what he said and about what the World Bank did with Mercer and the Mercer study, the old Mercer study, saying that, concluding that about 10% of investment risk is climate risk. It's probably an underestimate. And I was going to say, in this context, the financial crisis of 07-09 brought this term that all of you have heard, I'm sure, many times, to made it popular: black swans. Well, I think we should think about climate risk as a black swan for the 21st century, and it's a very nonlinear crisis risk. And finally, let me mention what Laurence Toubiana said. No, I couldn't pick up on all the points, but of course, she's in the thick of things right now, and she brought, of course, in incredible political economy complexities that are at work at the moment. And I just hope that, as David and others mentioned, that she will have the stamina to bring this to completion. So, finally, let me close my remarks by thanking all those of you who have come here, thanking the panelists, the speakers, and I would also like to thank the organizers of this event, the Center on Global Economic Governance at Columbia SIPA, the United Nations Environment Program Finance Initiative, the Sovereign Wealth Funds Research Initiative, and CDP, who have all helped a lot in making this event happen. And let me close my remarks by inviting you to the cocktail reception and dinner, where we will have a second keynote by Laurence Toubiana, the special representative, again, the special representative of France for the 2015 Paris Climate Conference. Thank you.